Aloha, friends. It's Mr. Fisher here, and I just wanted to talk to you a little bit about investing in stocks. Most of us are going to do what's called going long on a stock. That means that we believe that the company has value and that over time in the future, the price of that share is going to go up in value because that's a company that is doing really well in whatever its business is. Just a reminder, the share of the stock, it's ownership. You actually become an owner of the company, and you're buying it from some other person you'll never meet in real life. And millions of investors are deciding individually all day long, do I want to sell my shares or do I want to buy shares? And that buying and selling is what sets the price. The price of a stock is only worth what someone else will pay for it. So on my screen, I have Tesla. And the reason I picked Tesla is because this is a great stock for investors that are looking for value, because when you went long on Tesla, you've probably increased in value substantially. So you'll notice it says Tesla Incorporated, and the current price is $854 per share. It's actually gone up, the price, $43 just today, and that's about 5% in value. That's a lot for one day. This is a company that investors are excited about. On this little chart, I don't want to click it because it'll open a new window, but I'm mousing across it. This is just today. Those millions of people buying and selling have driven the price basically up, but you can see it was a little more earlier today, 165, and now it's here at 154. But what about the last week? You can see in the last week, the price has gone up a lot. So if I had bought this, today is Tuesday, if I had bought it Wednesday of last week, I could have purchased it for $750. So just in 1 week, the value of that share has gone up $100 simply because there's more demand for it than there is supply. So in order for another investor to sell it, I have to pay right now $154 per share. Let's look at it long term. So when we say going long, that means we're really going to buy it and hold it. So let's say in 1 year, as far as going long, that's a short amount of time. So I'm going long. Look at that graph. A year ago today, you could have bought that share for $100. So imagine you bought it a year ago. Now you're looking at $850 in value. If you sell it right now, you'll earn $750. That is a stock that is amazing if you went long. To go even further out going long, you can see that 5 years ago, back in 2016, it was very cheap, $40 a share, and that went on for quite a while, many years, because Tesla was new. They weren't making any money, but people thought in the future it's going to be worth something. And sure enough, you can see on the graph, in the last couple of years, Tesla has started to earn a profit. They're selling cars, people love them, and it's really driving their business. So that's what we call going long. It just means you buy the stock, you hold it for a long time. In the future, it's worth more money, and that's when you sell it. Let's look at Microsoft. Now, Microsoft is a much older company than Tesla. It's been around for a long time, and it's a very mature company. Tesla is still growing rapidly. Microsoft is mature. It's not really growing at a real fast pace. This is a company that people might want to short. So when you short a company, what you're saying is, I believe the value of that stock is too high, the price is too high, it's overvalued, I'm going to bet against that stock price. So what happens is, just through the market, just like I can buy and sell shares, I can go and essentially borrow a share of Microsoft from another investor who's going long. They will allow me through an institution to borrow that share because they're not going to sell it. They're going to be holding it for a long time. So I will basically take their share, sell it, wait for the price to fall, and then buy it back and return that share to the original owner. And the difference in the prices is profit for me. Now, this is much riskier. If I just went and bought Microsoft right now, you can see it's trading at $215. The most I could possibly lose is that $215, right? If it goes all the way down to zero, which it's not going to, but the most I could lose is 215. But if I short it right now and that price goes up, and you can see just in the last week, the price has been much higher. Well, we're only looking at $4 higher. But in theory, it could go up and up and up and up and up, and I could lose an unlimited amount of money. So short selling is much riskier. You're betting against the company. So let's just say I had a time machine, and I went out and I decided back around Christmas, around 24th, 28th of December, I looked at Microsoft and I said, you know what? It's overvalued. I'm going to short the stock. So I basically borrow that share at this price of $224, and I waited and waited, and sure enough, it started to go down in value. And right here, if I had perfect information, I go, you know what? $212 a share, that's as low as it's going to go. I'm going to go ahead and buy that back. And I return that share to the original investor. So I sold it at $225, and I bought it back at $212. I made $13 in profit by letting that fall in price. This is 6 months for Microsoft. You can see that in the past half a year, it's been as high as $231. And this is why short selling is so dangerous. When you look at it day to day, month to month, week to week, the peaks and valleys are much bigger. But by and large, companies go up in value. So the idea that you're going to buy a company at one of these peak prices, wait for it to fall, and then sell it at a high price and wait for it to fall and buy it back, that's very, very risky behavior. So I just wanted to do a quick, brief video here, so I want to stop myself. Most of the time, we're going to go long. That means we believe in the company, we believe in their products, we believe in their services, and we believe that this is a valuable company. When we short sell, we're saying this is overvalued, or this company is going to decline in the future, and we're betting against it. When we play the New Jersey stock market game, you'll have $100,000 to invest. I would say you want to go long on companies you believe in, but maybe hedge your bet. That's called a hedge. And try shorting some companies. You might really make some good money. So I don't know if this is helpful. I think it made sense, but feel free to email me with any questions, and I'll see you around. Bye-bye.